So there's a real war on in terms of democratization of access to alternatives between product providers and parts of the value chain that are bringing single manager, micro focused, single strategy products to market that are heavily branded and heavily promoted, but very concentrated in terms of their risk and very concentrated in terms of their ability to maintain liquidity. And against that, most of the clients that we're working with, those in-house staff that are seeking to push the market, they're trying to bring multi-strategy, multi-sub-asset class, basically better diversified strategies to market, still offering access to high quality private market alternatives, but not one manager's micro bets, but a diversified range of opportunities packaged up, which has better risk posture and better liquidity than those more focused strategies. And there's a real fight between that single manager, single strategy branded set of alternatives and the multi-manager, multi-strategy set of alternatives that we tend to work on. The three things that they were very focused on at the FII conference were diversification, diversification, and diversification. There's a lot of concern about what's going to happen with U.S.-China trade relationships, geopolitical relationships, also trade relationships between China and Europe, between the U.S. and all its trading partners. So a lot of uncertainty around trade, a lot of uncertainty around the Chinese economy, whether that becomes a locomotive for growth again or not, which is interrelated with that trade friction. And then concern about what happens with this AI digital bet that we're making. Are we underestimating collectively the transformational and productivity improvement prospects from AI and digital, or are we overestimating it? It's probably not a big problem for markets if we're underestimating things. But if we're overestimating, if we're investing too much, that could be a bubble and that could create problems. And the last risk factor is actually oil. I was in the Middle East, where many of the funds are funded out of fiscal surplus from very high oil revenues, with oil still trading at $60 a barrel. If we had peace in Ukraine, peace in the Middle East, and associated with that reinvestment in the Russian or Iranian oil sectors, oil prices could move to be a lot lower quickly. That would be a good thing for the global economy. It would not be a good thing for some of those funds in terms of the fiscal balances of their governments. So that's another risk factor that people are thinking about. And against that, really, the only answer is diversification. Nobody thinks they can sit on the side in cash. The S&P 500 is up 17% year to date as we sit here. So nobody wants to ride that out. Nobody wants to give up the opportunity to be fully invested. And at the same time, they're worried about risk. So the answer to that is just diversification.
Very interesting. Well, thank you so much, Rich. And thank you for tuning into BERYL Elites.